Right now, as you're watching this, 14 days remain until a regulatory cliff hits that will fundamentally change the silver market forever. 14 days until Washington state residents lose 10% of their purchasing power overnight through a tax repeal. 14 days until China's export control framework fully activates, locking refined silver inside their borders to fuel their solar and electric vehicle dominance. And here's what nobody is telling you. This isn't about whether silver will go up. It's about whether you'll be able to get it at all. Because when January 1st, 2026 arrives, three simultaneous forces converge: supply restrictions, tax penalties, and industrial demand acceleration. And by the time most people realize what's happening, the window will have already closed. If you own silver, are thinking about owning it, or simply want to understand why the next 2 weeks matter more than the next 2 years, pay very close attention, because this is not hype. This is not speculation. This is documented regulatory reality, and the clock is running. Let me show you something that should make your blood run cold. December 18th, 2025. Silver is trading at $64.47 per ounce. That's an 85% gain year to date, crushing gold's 30% return, obliterating the S&P 500, and now sitting at levels not seen since the early 1980s. But here's what the headlines aren't telling you. This isn't a speculative bubble. This is a structural repricing driven by something far more dangerous than momentum. 5 consecutive years of supply deficits. 800 million ounces missing from global supply since 2021. That's not a number you should gloss over. 800 million ounces. That's equivalent to an entire year of global mine production simply vanished, consumed by industries that cannot function without it. And those industries are accelerating, not slowing down. Solar panels, electric vehicles, AI data centers, 5G infrastructure. Every single technology defining the 2026 economy depends on silver, and we're running out. Now watch what happens when we map this against what's coming in 14 days. December 31st, 2024, China's Ministry of Commerce released the 2025 Dual-Use Items Catalog. That document went into effect January 1st, 2025, but here's the part most analysts missed. The enforcement mechanisms, the licensing requirements, the export restrictions, they don't reach full operational capacity until January 1st, 2026, 2 weeks from now, and silver sits right in the crosshairs. Why? Because silver is essential for 5G deployment, advanced electronics, aerospace applications, missile guidance systems, satellite infrastructure. China has classified these materials as dual use, civilian and military, which means they require strict export licensing. And when China requires export licensing, they're not streamlining trade, they're choking it off. We saw this exact pattern with gallium in 2023, germanium in 2024. Both crashed Western semiconductor supply chains within months. Silver is next. And unlike gallium or germanium, which most people have never heard of, silver sits at the foundation of the global energy transition. China controls 80% of solar panel manufacturing. They refine the majority of strategic minerals globally, and they're about to lock that supply inside their borders to ensure their domestic industries do not face shortages while the West scrambles. This is not speculation. This is the documented playbook. Here's where it gets worse. At the exact same moment China tightens the supply spigot, U.S. state governments are attacking the demand side with tax policy. Washington State, January 1st, 2026, sales tax exemption for precious metals repealed. If you live in Washington and you walk into a dealer on January 2nd to buy $10,000 worth of silver, you will pay approximately 10% sales tax, state and local combined. That's $1,000 gone. Not to premiums, not to dealer markup, to the government before you even take possession. Maryland already did this July 1st, 2025. 6% sales tax on all bullion purchases unless you physically buy them at the Baltimore Convention Center, which most people are not going to do. Meanwhile, New Jersey went the opposite direction. Effective January 1st, 2025, they enacted a full sales tax exemption for bullion purchases over $1,000. Geographic arbitrage. If you're in a taxed state, you now have an incentive to structure purchases through tax-free jurisdictions or offshore storage. But here's the kicker. Washington State also increased its capital gains tax to 9.9% retroactive to January 1st, 2025, for gains over $1 million. That means you pay more to buy and you pay more to sell. The window is closing on both ends. Now let me prove this matters with the numbers behind the industrial demand explosion. Solar photovoltaics. Confirmed data from the Silver Institute projects, solar demand alone will consume 230 million ounces in 2026. Let that sink in. One industry, 230 million ounces. Total global mine supply is roughly 800 million ounces annually. That means solar now represents nearly 30% of all silver production. And it's accelerating. Why? Because the technology shift happening right now is locking in higher silver usage, not reducing it. The industry is transitioning from PERC solar cells to TOPCon and HJT heterojunction technology. These newer cells are more efficient, but they use 50 to 80% more silver per panel than the older generation. Manufacturers can't reduce silver loadings without sacrificing efficiency. This isn't like substituting aluminum for copper in wiring. Silver's electrical conductivity, thermal properties, and corrosion resistance are irreplaceable in high-performance applications. The solar industry tried to reduce silver usage. They cut it by 35% over the last decade. But the technology upgrade just erased all of those gains and then some. Demand is structurally locked in. Electric vehicles. Each EV requires 25 to 50 grams of silver compared to 15 to 28 grams in a traditional internal combustion engine. That's 2 to 3 times more silver per vehicle. Global EV production is projected to hit 30 million units by 2030. Do the math. That's 750,000 to 1.5 million kilograms of additional silver demand annually from this sector alone. And that doesn't even account for the charging infrastructure, the grid upgrades, the renewable energy integration required to power those vehicles, all of which are silver intensive. Then there's the hidden driver nobody talks about, artificial intelligence. AI doesn't use much silver directly in chips, but the energy infrastructure required to support AI data centers is a massive new source of demand. These facilities require redundant power systems, advanced cooling, renewable energy integration to meet carbon targets. All of that infrastructure uses silver in switches, contacts, bus bars, and grid connections. Microsoft, Google, Amazon, they're all building out data center capacity at unprecedented scale. That demand wasn't in anyone's models 3 years ago. It's here now. And it's growing exponentially. So let's map this against supply. The market is confirming a 5-year cumulative deficit approaching 800 million ounces. The projected shortfall for 2025 alone is 115 to 206 million ounces, depending on which analyst model you trust. COMEX and LBMA vaults, the 2 largest physical silver repositories in the Western world, are reporting record withdrawals. Registered inventory, the metal available for immediate delivery, is at multi-decade lows. And here's the signal that should terrify every paper silver holder: backwardation, spot prices trading higher than futures. In a normal market, futures cost more than spot because of storage costs and time value. When spot trades above futures, it means people are paying premiums for immediate physical delivery over future promises. That's panic buying. That's industrial users realizing they can't afford to wait. That's the market screaming physical shortage. Now here's where the pattern becomes crystal clear. China doesn't restrict exports randomly. They do it when they've secured domestic supply and they're ready to weaponize scarcity. Gallium and germanium in 2023 and 2024. Rare earth elements expanded in November 2025. Silver in January 2026. Same playbook, same outcome. They announced the regulations months in advance, giving themselves time to stockpile and adjust domestic supply chains. Then they flip the switch. Export licensing becomes impossible to obtain. Delivery times extend from weeks to months. Premiums explode. Western manufacturers panic. And by the time governments react, it's too late. Supply chains are already disrupted. Prices have already spiked. And the only option is to pay whatever China demands, or find alternative sources that don't exist at scale. This is economic warfare through supply chain dominance. And silver is the next battlefield. So let's talk about what this means for you. Not theory, not speculation. Practical allocation in a world where the rules change in 14 days. There are 3 tiers of silver ownership, and understanding which tier you need is the difference between being protected and being exposed. Tier 1, the insurance stack. This is survival and barter. If the banking system freezes, if there's a currency crisis, if you need to transact outside the digital grid, this is your fallback. Target quantity, 100 to 200 ounces. At $64 per ounce, that's $6,400 to $12,800. Not a small amount, but not unattainable for most people who've been planning. Priority, immediate acquisition before year end. Why? Because if you're in Washington or Maryland, waiting until January means paying 10% more through sales tax. And if China locks exports, premiums will spike far higher than 10% anyway. The vehicle for this tier is 90% US junk silver, pre-1965 dimes, quarters, half dollars. Why? Divisibility. If silver hits $100 per ounce, a 1-ounce coin is worth $100. That's not useful for buying groceries or paying for gas, but a silver dime at that price is worth roughly $6 to $7. That's usable. That's functional. Junk silver also carries lower premiums than sovereign coins, is harder to counterfeit, and is instantly recognizable to anyone in the United States. This is your liquidity layer. Tier 2, the wealth shield. This is investment and inflation hedging. You're not buying for survival. You're buying to protect purchasing power over a multi-year time horizon. Target quantity, 500 to 1,000 ounces. Priority, acquire before January 1st, especially if you're in Washington or Maryland. Vehicle, 1 ounce sovereign coins. American Silver Eagles, Canadian Maple Leafs, British Britannias. Avoid high premium collectibles. Avoid numismatics. In a crisis, silver is silver. Fancy packaging and limited editions don't matter. What matters is weight, purity, and liquidity. Strategy. If you're in a tax-hostile state, consider offshore storage in jurisdictions like the Cayman Islands or Singapore, or allocated storage in a tax-friendly U.S. state like Delaware, Texas, or Nevada. This allows you to legally avoid sales tax on acquisition and provides geographic diversification in case domestic confiscation becomes a concern. Yes, confiscation. Executive Order 61. O2 in 1933 seized privately held gold. It can happen again. Diversification across jurisdictions reduces that risk. Tier 3. The speculative squeeze. This is for those betting on a systemic supply shock and willing to tolerate volatility. Target quantity, 2,000 ounces or more. Vehicle, 100 ounce or 1,000 ounce bars for lower premiums and density. Warning. Expect volatility. If silver hits $100, history suggests a 20 to 30% correction is likely before the next leg higher. This tier is not about timing. It's about holding through the China lock supply shock of 2026 and 2027. If you're in this tier, you need conviction because the ride will be violent. But the payoff, if the thesis is correct, is generational wealth preservation and potentially significant gains. Here's what you need to understand about timing. The people who do best in supply shocks are not the ones who wait for confirmation. They're the ones who position before the market realizes what's happening. By the time silver shortages make CNN, by the time your neighbor asks you about buying silver, by the time premiums spike to $20 or $30 over spot, the opportunity is gone. You'll be competing with panicked retail buyers, industrial users scrambling for production materials, and institutions finally waking up to the thesis. Right now, in mid-December 2025, premiums are elevated but manageable. Generic rounds are running $3 to $5 over spot. Sovereign coins are $5 to $8 over spot. Junk silver is relatively tight but still available. In 6 months, those premiums could double or triple. In 12 months, availability might become the primary constraint, not price. And here's the part that separates this situation from previous silver squeezes. In 1980, the Hunt brothers drove prices to $49, but that was speculative leverage. It collapsed when the exchange changed margin requirements. In 2011, silver hit $48 on monetary fears post-financial crisis, but there was no structural supply deficit. This time, the deficit is real. The industrial demand is locked in. The geopolitical supply restrictions are documented and scheduled. This isn't speculation. This is arithmetic. When you consume more than you produce for 5 consecutive years, inventories deplete. When you restrict exports from the largest refining hub, prices diverge. When you add tax penalties on top of supply constraints, you create a perfect storm, and that storm makes landfall January 1st, 2026. Now let's address the objections, because you're thinking them right now. First, what if silver crashes? What if there's a recession and industrial demand collapses? A fair concern. Silver is volatile. It's called gold on steroids for a reason. 50% swings are normal. But here's the counter. In every previous recession, central banks responded with monetary expansion, lower rates, quantitative easing, currency debasement, and precious metals rallied during those periods because they hedged monetary risk, not economic risk. The only scenario where silver truly collapses is a deflationary depression where industrial demand vanishes and monetary authorities allow deflation to persist. That has not happened in a major economy since the 1930s, and even then, gold was confiscated precisely because it was holding value while everything else collapsed. Second objection. What about substitution? Won't industries find alternatives if silver gets too expensive? They're trying. Solar manufacturers have been working on copper alternatives for years, but the efficiency losses are significant. Switching from silver to copper reduces panel efficiency by 2 to 4%, which in a competitive market means losing contracts. Industries will tolerate higher silver prices before they accept performance degradation. And even if substitution happens, it takes years to retool manufacturing lines, years to test and certify new materials, years to scale production. In the meantime, demand remains inelastic. Third objection. What if new mines come online and flood supply? Mining projects take 10 to 15 years from discovery to production. Even if a massive deposit were discovered tomorrow, it wouldn't hit the market until the late 2030s. And 70% of silver production is a byproduct of copper, lead, and zinc mining. That means silver supply doesn't respond directly to silver prices. Copper miners don't ramp production because silver hit $70. They ramp production when copper economics justify it. Silver comes along for the ride. This creates structural supply inelasticity that amplifies price moves during shortages. Fourth objection. Aren't you just fear-mongering to sell silver? I'm not selling you silver. I don't run a dealership. I don't take commissions. What I'm doing is pattern recognition. China restricts strategic materials. Documented. U.S. and states repeal tax exemptions. Documented. Industrial demand accelerates. Documented. Supply deficits persist for 5 years. Documented. These are not opinions. These are facts. And facts don't care whether you find them alarming. So here's your action framework. If you're in Tier 1 and you have 0 silver, your priority is acquiring 100 to 200 ounces of junk silver before December 31st. Period. If you're in Washington or Maryland, this is non-negotiable because waiting costs you 10% immediately. If you're already in Tier 1 and you're considering Tier 2, now is the time to scale into 500 to 1,000 ounces using sovereign coins, spreading purchases over the next 2 weeks to dollar cost average in case there's a short-term pullback. If you're aggressive and targeting Tier 3, you're buying bars for density and accepting volatility as the cost of potential outsized returns. But in all 3 cases, the deadline is the same, January 1st. After that date, the game changes. Here's what to avoid. Don't buy collectible silver or numismatics unless you're a coin collector. Don't chase high premium limited editions. Don't over-allocate beyond your risk tolerance because if you panic sell during a correction, you lock in losses. Don't rely exclusively on paper silver like SLV or unallocated accounts, because in a true supply shock, the disconnect between paper prices and physical availability will widen dramatically. And don't wait for the perfect entry. In markets driven by supply shocks, waiting for confirmation means overpaying or missing the window entirely. The convergence happening in 14 days is not a prediction, it's scheduled. China's export controls activate January 1st. Washington's tax repeal activates January 1st. Solar demand projections for 2026 are locked in based on installations already contracted. The deficit isn't a forecast. It's the mathematical result of consumption exceeding production for 5 straight years. The only variable is how fast the market reprices this reality. And repricing happens suddenly, violently, and without warning. One day, silver is range-bound. The next day, premiums spike, dealers are sold out, and the conversation shifts from should I buy to can I even find it. If you've been watching silver for years, waiting for the right moment, this is it. Not because I say so, but because the calendar says so. 14 days until multiple structural forces converge. 14 days until the cost of entry increases through taxes, restrictions, and scarcity. 14 days until the market you're familiar with transforms into something fundamentally different. The question is not whether you'll regret acting. The question is whether you'll regret waiting. Subscribe, because in the next video, I'm breaking down exactly how the China lock will unfold month by month through 2026, which dealers are most likely to face supply shortages first, and the 3 indicators that will tell you when the squeeze has reached its peak. This isn't about panic, it's about preparation. And preparation requires action before urgency becomes desperation. The clock is running, the window is closing, and the only question that matters is whether you'll see it clearly enough to act while there's still time.